Hello, everyone. Good evening and welcome to this session. I hope I am loud and clear. Uh, can everyone hear me? I just want a thumbs up just to know that everyone can hear me and see me. And I'm going to present something very interesting for the next 1 hour or so on dollar INR. Dollar has been a big pain point for. Okay, thank you. Thank you. I can see a few thumbs up. Okay, so you can just raise your issues or your questions on the chat box. I will keep opening the chat box once a while. So if you have any questions, we will. I'll explore the chat box and I'll answer the questions. So just quick brief about My Forex Eye. We founded My Forex Eye in 2014. One of the primary drivers was to address the knowledge gap in forex markets to companies. And we do forex, we do consulting, we do trade finance, we do training. So everything under the sun about foreign exchange markets, My Forex Eye is the go-to company. And let me give a small introduction about myself. My name is Ritesh Victor, and I am the co-founder of My Forex Eye. I have been in this market for 25 years. I started my forex market journey in 2000 and just completed 25 years. I was a consultant, and I was head of treasury of a very large company, managing close to 500 million plus exposures, $1 million of exposures. And since 2015, we founded this company, and I am managing My Forex Eye along with my business partner. Okay, so I am a qualified chartered market technician, and I am a NISM registered investment advisor and an MBA in finance. So that is my credentials. So let us get into the dollar INR. You know, dollar INR has been in the market, in the news for all the wrong reasons. Rupee has been continuously weakening, and all the exporters and importers are running helter-skelter. How to manage risk? What is the forecast of dollar INR? How is it going? How do I manage my risk? So, a lot of volatility. I will try and answer a lot of questions as much as I can. Okay, so if you have any questions beyond what I am telling you, please feel free to write it out on the chat box. Okay, so let's get going. So what are we going to talk about? We are going to talk about the new dollar INR ecosystem. Okay, we are going to talk about changing dynamics. What was the dynamics many years back, and how the dynamics have changed in from 2020-21 onwards. We are also going to talk about the change in RBI. Okay, so we call it the evolving RBI. There is a big change at RBI. RBI's policies, their direction, their objectives, a lot of it. And then obviously we'll come into some smart trade finance funding options for both exporters as well as importers. So this is what we're going to talk about. We're going to talk about the dynamics that have changed. Then we're going to talk about how RBI is looking at controlling the exchange rate, controlling, managing, monitoring, offhand, whatever it is. We're going to talk about that. And then some funding options for both exporters and importers. Okay, so first two will be understanding the market, understanding the regulator of the market. 3 and 4 will be more about application. Okay, that will be for all exporters and importers. How do I fund my working capital for exporters and then for importers? Okay, so let's get going one by one. Okay, now this is the trend of dollar INR since 2000. Okay, now I want to start with this because I want you to explain and I want you to understand what has been the historical trend and how trend has been changing. Okay, I will take you to the entire journey one by one. Again, ladies and gentlemen, if you have any questions, please feel free to write it on the chat box. I will also have a question and answer session at the end of the presentation, and then I will take it one by one on one. But you are most welcome to write it on the chat box. Okay, so this is dollar INR. I want you all to focus on two phases. Okay, the first phase is highlighted with a yellow circle. Okay, if you look at it, that is from the period of 2000 till mostly about 2007 and some part of early 2008. You know, the dollar INR was static, horizontal. It was between 40 to 44. Okay, for 10 years, the direction was static. Now then see how the change happened from 2008 onwards. 2008 we had the subprime crisis, and after the subprime crisis we saw the rupee weakening heavily from 40 to 50s, and then rupee gaining again back to 44, 45, and then from 2012, 11, 12 onwards, it has been a consistent uptrend in dollar INR. Okay, so if you see the blue arrows, it is indicating upward movements, and then red arrows indicating downward movements. Okay, and see how it has steeply moved since 2011 and 12. Okay, now what am I going to tell you? What am I trying to tell you is that the dollar INR has a consistent uptrend. Okay, unlike the period of 2000 to 2007-8, where it was sideways, but from 2008-9 onwards, it is a consistent uptrend. Okay, now very important. The second important conclusion is, if you see, there is a lot of two-way volatility. For those 8-9 years, we had sideways volatility. Now you have an uptrend. You have higher highs and higher lows, but you have a good amount of two-way volatility. Prices go higher, and then prices comes down as well. Okay, so if you look at 2025, just the last year, the price went higher in February, March. It went higher to almost 87, 88. And then in 2 months, it came down to 83.75, between 83, 84. And then since May, June, it has been a consistent uptrend from 84, 85 to around 90, 91. That is the most latest last 1 year. Okay. So the conclusion is the last line on the right side that I've written: longer periods of rupee weakness and very smaller periods of rupee gain. Okay, so that is what is written in the chart as well. Consistent dollar INR uptrend. Okay, higher highs and higher lows, very clear indication that it is an uptrend, and smaller periods of dollar declines, bigger periods of dollar rises, and smaller periods of dollar decline. Okay, so first 10 years different, and from 2008-9 onwards, the trend is very, very different, and that is the change that we have to understand. I will dig more and I will tell you more about it. Okay, now I showed you the dollar INR spot direction, which was consistently uptrend. Now this is the dollar INR forward premium. What is a forward premium? Forward premium for importers, it is the hedge cost, and for the exporters, it is the premium that you receive. If I take a simple forward for 1 month, 2 months, 3 months, then this is the percentage that I get. Okay. Now, if you see again, historically, I have plotted this chart from 2000 till now. So it is data of more than 25 years. So if you look at the period prior to 2020, okay, I want to segregate this entire data into two parts. The first part is from 2000 till 2020, which is like 20-year period. And then from 2020 onwards till now, which is like the 5-6 years period. Okay. Now, if you look at the first 20-year period, the premiums were significantly higher. Okay. The range was very large. The minimum premiums used to be around 2%, and the maximum that it went, it also went to 8-9%, which was like extraordinary. But most of the time, the premiums have been between 2% to 6% annualized. Okay. So what does 2% mean? Simple, 2% of the spot. If I say premium is 5% and spot is 91.50, then 1 year premium is 5% of 91.50. And if you have months, you just divide by the number of months. Okay. So what I'm trying to tell you is the first 20-year period, the premiums were between 2 to 6%, a very, very big range. Okay. But if you look from 2020 onwards, there has been a big decline in the forward premiums, and the premiums now hover between 1.5 to 3.5%. Currently, the premiums are around 2.5 to 3%. Okay, so this is one of the big changes that I want to tell you about dollar INR. What were the premiums earlier? It was between 2 to 6%, and now the forward premiums have come down. Okay, it is between 1.5 to 3.5%. It was, if you look at the chart, it was around 1 to 1.5 for a very long period of time, end of 23 and most parts of 2024. But after 2024, probably early 25 onwards, when US started decreasing interest rates, then the premiums started going higher. Okay, and currently the premiums are around 2.5 to 3%. Okay, if you look at the long-term average premiums are around 4 to 4.5%. So from the long-term average, we are still much lower. If average was 4.5%, currently the premiums are around 2.5, 3%. Okay, so hedge cost for importers lower than long-term average, and hedging premium for exporters again lower than long-term average. Okay, so this is the second part, one of the indicators that I wanted to give you, that how forward premiums have changed over the long period of time. Now, I want to tell you, I am trying to get both of this data together, and how does that give you some kind of an insight, and using that insight, you can take some kind of a decision. Okay. Now, spot we have seen a lot of time, it was static and then it continuously went higher. Premiums we have seen it was between 2 to 4% and now it has come down. Okay. Now here what we did was we did an exercise. Okay. We did an exercise for the last 25 years. From 2000 till now, we did this exercise. And what was the simple research and what exercise that we did? We took a forward every working day. Okay. And when we took a forward every working day, what happened was we do it for three maturities. One is 3 months, the other is 6 months, the other is 12 months. Okay, so every day I am taking a forward for 3 months, 6 months, and 12 months. And then what am I doing? I am comparing that forward that I have taken after 3-month maturity, and I'm comparing that with the actual spot at maturity. Okay, so simply it is a comparison between doing a forward, how has that worked out, and not doing a forward, how has that worked. Okay, so it is a simple comparison between forward rate and the spot at maturity. So in other words, what am I trying to do? If I'm doing a forward, I am getting the premium. An exporter is getting the premium, forward premium, and importer is paying the premium. So I am comparing that forward premium with the natural weakening of the rupee. How much has the INR changed? Average rupee change on a periodic basis, and then compare that with what is the forward premium. If I would have done a hedge, then what is the premium I would have paid or received? Okay, so simple comparison between the second and the third column, the annualized premium, that is what I am getting for exporter, importer I am paying, and what is the natural weakening of the rupee. Okay, that is on column, the second column from the left. So if you look at these two variables, I have bucketed these two variable comparison for 3 buckets. Okay, 10 years. The first 10 years from 2000 to 2010, the second 10 years from 11 to 20, and the third 10 years is from 21 to current now. Okay. So first 10 years, remember the market was sideways. Okay. So premiums were much higher. It was around 2.5 to 2.9%. And the rupee change was less than 1%. Okay. And the carry, what we call as the carry. Carry is the simple difference between the annualized premium and the average rupee change. Okay. Because if an exporter does it, I get that premium and rupee change is less. And if an importer does it, he has to pay the premium and the rupee risk is much lesser. Okay. So in that 10 years, the carry was positive. The weakening was much lesser and the annualized premiums were much higher. Okay, so that is the story of the first 10 years. Carry was largely positive. Now let's do the same analysis from 2011 to 2020. Okay, the next 10 years. In the next 10 years, things changed dramatically. The premiums went higher, the weakening also went higher. Okay, but the carry was still positive. Okay, the premiums were still more than the average rupee change, but the carry that was around 2 to 2.5%, the carry now reduced to less than 1%. Okay, so that is the real big change in the first 10 years to the next 10 years. Okay, now the most critical part is the third, the final table at the bottom. Okay, that is the comparison of forward rate with the spot and maturity for the period from 2021 onwards till now. So, like 5-6 years. So, in the last 5-6 years, the things have reversed, the things have flipped. Okay, the rupee change is far larger, the rupee weakening is far larger, and the premiums are much smaller. The rupee weakening is far larger and the premiums are much smaller. As such, the carry has become negative. The carry has become negative. Things that was positive for almost 20 years, now that has changed in the last 5 years. Okay, so it is a dramatic flip. Now, if it is a complete reversal of what it was, I'll tell you what are the consequences and what are the things that you need to think very seriously about managing forex risk for both exports as well as imports. Okay, but keep this in mind, what was there in the first 10 years, what was there in the next 10 years, and what happened in the last 5 years. How the carry from highly positive first reduced to slightly positive, and now the carry is completely reversed. Now, I have just written some points, what we just discussed in the previous slide. 2000 to 2010, carry was positive, rupee depreciation far lower than premiums. Okay, so exporters used to hedge, keeping high hedge ratios because they knew that the premiums that I am getting is far more and rupee weakening is far less. Okay, so exporters were actively hedging. But importers, it is the reverse. Importers were very reluctant to hedge because the hedge cost or the premiums were very high and actual weakening was much lower. So importers very rarely hedged and they kept very low hedge ratios. Okay, very low hedge ratios. Now, what happened in 2000 to 2010? The carry remained positive, but it has reduced substantially. From 2.5% carry, the carry has now become less than 1%. When I say carry, it is the forward premiums minus the actual rupee weakening in that period. Okay, so 2010 to 20 was the first period which started indicating about the change in market dynamics. Okay, and in addition to the carry reducing substantially from 2.5% to just less than 1%, what we saw in 2010 to 20 was a significant increase in two-way volatility. Okay, 2000 to 2010, it was completely sideways. It was moving up and down, but it was moving in a one broad range. 10 to 20, it went higher, but significant two-way movement. The next slide is the really critical slide. The recent 5 years. The recent 5 years when the things have changed dramatically. Things have completely flipped. Okay, carry, which was heavily positive, became negative. Okay, so rupee weakening is far more than the forward premiums. Okay, now understand the consequence of this dramatic change. The consequence is exporters were hedging for 20 years. Regularly, they were hedging for 20 years and they were making money. Importers were not hedging and they were happy. Now, suddenly, for 5 years, exporters who have been hedging for 20 years, now in the last 5 years, they are seeing regular losses. Okay. Now, importers who had not hedged for 20 years, they are now realizing gradually that the dynamics have changed. Of 20 years, the dynamics have changed. Now, I need to very seriously look to hedge, because the weakening is far, far more, but the premiums are far less. Okay, so that is what has changed dramatically in the last 5-6 years, and that has led to all the exporters and importers to wake up, suddenly wake up, notice the change in the dynamics, and then completely change and revamp their risk management policies. Okay, exporters who were hedging, suddenly realizing in 2-3 years that this blind hedging that they were doing for 20 years, that needs thought. Okay, I cannot blindly hedge the way I was hedging for 20 years. I will incur regular losses. Similarly, importers who were sitting tight and not hedging for 20 years, they suddenly realize that not hedging is not a strategy anymore. Rupee weakening is becoming very swift and very fast. Okay, so the bottom line is exporters, importers are now both waking up and trying to revamp their risk management policy, because what they have been doing for 20 years, they are not able to do it again. Okay, I'll give you a very simple, uh, uh, experience that I very recently had. Okay, we met a dollar importer. Okay, very large importer. They have about 50-55 million dollars of payment every month. Okay, importer, very large importer, Delhi-based importer, and for 20 years they were not hedging, knowing very well that the rupee weakening is less, premiums are more. In the last 2-3 years, they have realized that this 20-year strategy is not going to continue, and we need to do something. So we met them last week, and then we devised a strategy that no hedging for importers cannot continue. It is disastrous, and we need to have some kind of a risk management policy, some kind of a risk management philosophy. Okay, no hedging is not a strategy anymore. It's going to be a very painful and very loss-making strategy. Rupee is weakening heavily, and the way the geopolitical situations are evolving, I'm sure all of you are reading what Donald Trump is doing, how the geopolitics throughout the world is working out. The volatility is going to remain. Okay, and voters who have been very actively hedging, now they are realizing that hedging using forwards are not effective anymore. We need to do something far more than just simple forwards. Okay, now the bottom line is the last line that I've written in this slide. Two-way volatility is going to continue, and forex requires constant risk management. Okay, it is not a static risk management, it is a dynamic risk management. Okay, now I want to ask a question. Okay, from whatever we have completed, I'm sure all of you have a reasonable amount of market experience. I want to ask a question. You have to just answer as yes or no. You can type it on the chat box. Okay, do you really think that the dynamics of dollar INR has changed in the last 5-6 years compared to the previous 20 years? Has the dynamics really changed in the last 5-6 years compared to the last 20 years? Just type yes or no. Okay, okay. I've got some responses. Please go on. Please go on. Again, please be very honest and very frank. Okay. Any of your opinion is extremely welcome, and I want to understand, because we look at this market every day, day in, day out. You might be looking day in, day out on a weekly basis, monthly basis, whatever your frequency is. But I just want to get some kind of a response that do you really think the dynamics have changed? Okay, I have got all yeses. Okay, very good. The pace of depreciation is very high. Okay, very good. Very good. Fantastic. One more last question before I get to the next slide. I'll keep asking questions in between. One more question. Do you think that the risk management process that you had earlier, you need to change that now? Do you think the risk management process that you had earlier, you have to change that now? Yes or no? Okay. Okay. Keep answering. I'm getting a lot of responses. Thank you. Thank you for the active engagement. Thank you. Okay. So in both the questions, I get a yes. Thank you so much. Uh, Changed already. Fantastic. I believe so. Yes. Fantastic. Yes. Yes. Very good. Very good. Fantastic. Fantastic. Great. So the bottom line, yes, but waiting for FII and EU investment. Okay, very good, very good. So looking at market developments. Okay, but let me tell you to everyone, thank you for the participation, thank you for your responses. But let me tell you one thing. Uh, these developments, geopolitical things will always be there, but understand the real dynamics, the root cause of the dynamics. The root cause of the dynamics are geopolitical concerns. The root cause of the dynamics is also that India is getting internationalized. Okay, lot of FDI is coming into India, lot of FIIs are also coming into India. Indians are going abroad, lot of Indian investments are also happening abroad. Okay, so the bottom line is because of so much of international activity, inflows and outflows, volatility is going to remain. Okay, that is the bottom line. No one obviously knows the direction. Only God knows the direction, or God knows what is going to happen. But volatility will remain. And I'll tell you one more thing in the subsequent slides. What is likely to remain? Okay, and that is a very important variable for our overall decision making. Okay, so here what I am trying to indicate is about the central bank. Okay, now in India, central bank is a very big component in the management of exchange rate. Okay, so RBI is a very big variable to, if you want to analyze dollar INR, then RBI analysis is very important. Okay, now I want to explain how the tides have shifted from one RBI governor to the other. Okay, all of us are aware that late last year in December, the RBI governor changed. Earlier it was Shaktikanta Das, and now it is Sanjay Malotra. Okay, so if you understand what is this change, then you will understand far better what is happening in dollar INR. Okay, now Shaktikanta Das, the era was active intervention. Okay, the RBI was daily involved in managing the exchange rate, and RBI was actively managing to reduce the volatility. In fact, they didn't want any volatility. Okay, and they were using FX reserves in managing the volatility. Okay, so what happened was, I'll show you the next chart. In the next slide, you will see what I'm telling you, that how they managed so actively and how the volatility of the dollar INR came down substantially. Okay, and how the forex reserves also reduced. But then what happened is things changed substantially when the new governor came in, Sanjay Malhotra came in, and he came around middle of December last year. And then he had a very different ideology. Okay, his ideology was interventions are required very rarely, and it needs to be more of a market-led discovery. The price discovery should be by the market forces, and the RBI should not intervene, or RBI should not set a direction to the exchange rate. RBI should not interfere in the price discovery of the exchange. Okay, so direct interventions reduced substantially. Okay, and that was the primary reason you will see that since November, December last year, how the volatility in dollar INR increased, and before that, how it was very stable. Okay. Another thing what Sanjay Malhotra did was how he used reserves. See, what we are saying is they have reduced intervention. Okay. They did not eliminate intervention. It is not that RBI doesn't intervene. It intervenes, but they intervene very selectively. They don't intervene to direct the market. They intervene to reduce volatility. Okay. But one big change, what has happened is that instead of using the forex reserves, they found a very good way of managing the volatility through swaps. Okay, so now RBI very regularly does buy sell swaps, and in the last 2.5 months, they have already done it 2 times. Once 5 billion, and the next time they did 10 billion. Okay, uh, so swaps is one way of getting the dollar asset, but not using the reserves. Okay, so it's a very novel and a very different idea. But again, bottom line, be out of market, not intervention actively, intervene when required, when there is very large volatility, and a very different way of intervening, not using reserves directly. Okay, so now you see how what has happened to the exchange rate in different regimes. Okay, if you look at Shaktikanta Das era, okay, on the left side, if you see the exchange rate was very static, very static. Okay, if you look at the Sanjay Malhotra regime, we have seen very good volatility, very good and very high volatility. Okay, now I get a comment at the chat box that we are facing a lot of losses in Malhotra era. Okay, I wouldn't say any which era is right or wrong. All the eras are right. What we just need to do is we need to adapt ourselves. Okay, we need to adapt ourselves. We need to be careful and we need to be dynamic. If the era was low volatility, we need to hedge in a different way. If the era is high volatility, then our hedging strategy should be slightly different. Okay. But what you all need to understand very clearly is that the era has changed. Okay. And we need to adapt. We have to hedge. It is not that in that era when markets were stable, we need not hedge. You need to hedge again. That time also you need to hedge. Sorry. But the hedging ideology or hedging mechanism was very different. Here in Sanjay Malhotra era, the hedging mechanism is very different. Okay, both are right in their ways. Okay, obviously there are challenges in both sides. In a normal financial market, demand supply should be allowed to play, and the central bank should not intervene. You look at any major bank of the world, okay, except probably the Bank of Japan and People's Bank of China, RBI. These are the few Asian banks that intervene in the market. Okay, if you look at Western banks, banks which are much larger, you look at the Federal Reserve of US, they have nothing to do with dollar. Okay, let the dollar index find its way. European Central Bank, they have nothing to do with euro dollar. Okay, let the euro find its way. Okay, so intervention or non-intervention, it is a policy decision, and we, exporters and importers, need to be smart enough to understand the dynamic that has changed and how I need to adapt to the new level of dynamic. Okay, so if you are saying that in this era you are facing huge losses, that means obviously we can't control the market. We need to control ourselves. We need to control our decision making, and our decision making is in our control. Obviously, we cannot control the market. We cannot control where the exchange rate is going. Even the RBI cannot control it. They can only, maneuver it a bit here and there, but they cannot control it. The market is just too big. Okay, so the lesson for all of us is that we have to learn to adapt, and we have to learn to be smart enough to adapt to the market and hedge accordingly to the changing dynamics of the market. How to hedge, how much to hedge, which instrument to hedge, till what maturity to hedge, Those things, those guidance you will get from people like us, market professionals who are interacting with multiple participants in the market who have extensive market experience. So we can guide you how to do it in a more efficient and a more process oriented. So that is our expertise. That is our core forte. Okay, and take it from me, a lot of companies in the last 1 to 2 years have come to us not to look at where the market is going. They have come to us to change their process, to adapt to the dynamic market, how to make their processes and their systems dynamic to the changes that is happening in them. Okay, great. So let's go here. This is probably the last 2-3 slides of the session. Here I want to give you certain working capital ideas to both exporters and importers. Specifically, for exporters, because that is a very big advantage in using this. Importers, it is an advantage that depends on market conditions, but exporters, it is a very big advantage. Okay, I'm sure all of you will be aware that the government of India has reintroduced the interest subvention scheme on export packing credit. If you take the packing credit in INR, okay, you get a 2.75% action benefit if you fall under that eligible category of HS codes, HSN codes. But bottom line is you get a interest subsidy. Okay, interest subsidy. If you we were talking about the interest subvention on dollar exporters. If you take the packing credit in INR, okay, if you take in INR, you get a subvention. Earlier there was 3%, then it was changed 3, 2, 5, multiple things. Now there is a straightforward 2.75% subvention to exporters if you take packing credit in INR. Okay, I'm sure all of you are aware about it. All of you are aware about it. Now, but then again, unlike earlier time, there is a cap that the benefit can be a maximum of 50 lakhs. Okay. Again, 50 lakhs is not a small benefit, not a very large benefit, but nevertheless some decent amount of benefit. So in such a case, what is the most ideal working capital that a dollar export can take? What they can do is they can take a packing credit in INR. Okay, so that will come around. If you see the table on the right side, you will have a cost of around 7.5%. Okay, again, anything between 7 to 8%. Then you get an interest subvention. Okay, now the third point is the most critical point. What happens is if you take a packing credit in INR, you take an INR loan. Okay, let's say you take 10 crores now. Okay, this 10 crores you are going to repay from your dollar receivable that is going to come after you export your product. Let's say after 2 months, 3 months, 4 months, whatever. Okay, so from that dollar export, you are going to repay this 10 crores. Okay, so for that dollar export that is going to happen or receivable that you are going to get after, let's take 2, 3, 4, 5 months, you can take a forward for that receivable. And when you take the forward, you get a 2.84, 2.85% premium. Okay, so that is the simple dollar INR premium that we were talking about in the previous slides. So if you take into account that forward premium, and that premium you get a forward rate, and when your dollar comes in, you just use that forward rate to convert into INR, and then you pay the 10 crore PC loan that you have taken. Okay, so if you do that, okay, your interest cost reduces substantially. First, you get the subvention of 2.75%, and then you get the forward premium of 2.84%. Your net cost comes down to less than 2%. Your net cost comes down to less than 2%. And that is extremely cheap and extremely attractive funding option for your exports. So this is one way how the government of India is trying to subsidize or provide benefits to exporters. Okay. The other way is that you want to continue the earlier practice of taking packing credit in dollars. So that is simple. I take a $1 million loan I convert it into INR today. I use the INR. I get $1 million exports. So dollar inward repays the dollar loan. So that is the simple PCFC, the first table on the left. Okay. There, if you take a dollar loan, you pay dollar interest rates, which is 3.6%. If you look at the SOFR, 6 months SOFR, if you take, it's around 3.6%. And bank typically takes anywhere around 1.5% spread. Okay, so your total interest cost becomes 3.6 plus 1.5%, around 5.1, 5.15%. Okay, so that is what the interest cost is there when you're taking packing credit in foreign currency. So that is relatively very high, 5.13. But if you take packing credit in INR, get the benefit of the subvention of 2.75%, take a hedge, okay, take a hedge, get the benefit of the forward premium, your net cost comes down to less than 2%. Okay, now there is a lot of debate, lot of discussion about taking the forward because again there are discussions that rupee is weakening. I just showed you that the rupee is weakening more than the forward premiums. So why should I take a hedge? Okay, you can keep it open, but remember markets are markets. It can go up, it can come down, and your interest cost will also keep fluctuating. Okay, but if you take a hedge and get that premium, your interest cost is fixed at 1.9%. That interest cost cannot go to 3, the interest cost cannot become 0. Okay, so if the objective is to fix and freeze the interest cost, okay, I don't care where the currency is going because I have already availed a very attractive funding for my exports. Obviously, no one is going to get funding at less than 2%, but here is a way where exporters can take the advantage of the subvention and also the advantage of forward premium and get funding for exports at very attractive and very cheap prices. Okay, so all of you think about it, all exporters, okay, you should certainly looking at taking a packing credit in INR and getting the benefit of interest subvention. Okay. Now remember, it is for MSMEs and it is for eligible companies. So you need to look at whether your HSN, your product code, your HSN product code is eligible for subvention. If you are not eligible, then just remove the subvention factor and compare packing credit INR EPC rate minus the premium, and on the left side you will have SOFR plus the spread. Okay, so only the subvention component will go off. So you do that comparison. So whichever is cheaper, that is what you take. Okay, because all of us want to reduce our interest costs. Okay, great. So that is on the export side. So similarly, what you have is you have buyer's credit as a mechanism of funding imports. Okay, you have to do the same calculation. The items are slightly different. In INR, you have a straightaway 7.5% funding cost, but in buyer's credit, you have SOFR, you have a spread, then you have LC opening charges, and since you want to hedge it, you don't want to keep the risk open, you will have a hedge cost as well. Okay, so if you compare the two, both of them are very close to each other. In fact, bank spread can be reduced, it can come down to 0.5, and even the LC opening cost can also be reduced. So the idea and the thought that I'm trying to give to all dollar exporters is that you need to do this calculation whenever you are looking to avail funding. Okay, so if import funding, I have an import payment, I need some funding, I need to see if INR cost, which is 7.5%, is that cheap, or if I take a foreign currency cost, which will cost me SOFR, plus the bank charges, plus the LC opening charges, all the cost items on the left side will be for foreign currency, including the hedge cost. Remember, you typically do not want to keep the currency risk open, so you have to consider the hedge cost. Okay, so all inclusive cost, what is the rate, and INR funding, what is the rate? Okay, and you choose whichever is cheaper to you. What we have seen in practical experience is that when bank spreads and LC charges, opening charges are low, you typically get slightly cheaper, 0.5% cheaper buyer's credit fully hedged. And for all your imports, if you're a large importing company and you save 0.5% per annum, that is a substantial amount of saving that you can get. Okay, so the idea with showing these kind of calculations for both exports as well as for imports is that you need to look at smart ways of reducing interest costs on my funding. Whether I am funding for exports or whether I am funding for imports, I need to do these kind of calculations every time I am doing it. And these calculations will give you insights as to which kind of funding you want to typically take. For dollar exports, it is very simple calculation because you have a subvention. If there is no subvention, then you need to do the same calculation and come out and visualize and analyze which is the cheaper option. Okay, and for buyer's credit, if you're taking any kind of funding, evaluate all the costs, obviously include the hedge cost, and then check up which is the cheaper option. Okay, gentlemen, ladies and gentlemen, that is it from my side. Thank you so much. Now I put up everything to you. If you have any questions, you can unmute yourself and ask a question. Or if you want to type it on the chat box, you can type it out. We have close to 6 minutes left. Anything you want to ask, I will try my best to answer your question. So, all to you, the audience. One small request I have to all of you who have joined, thank you for joining. We have a community, we have a research community that follows us very closely. Okay. All of you who are interested in getting such insights, regularly on a day-to-day, on a weekly basis, please join our WhatsApp community. And I would also request each of you to give a feedback as to how was it and how did you like it. You have any questions, you are most welcome to ask now. I'm all there, please ask. Yes, buyer's credit can be used against Indian Bank's LC. Yes, but the answer to your question is yes, you can use it. Again, if you want to discuss in detail, please reach out to me. I will connect with you and I'll clarify your questions. If you have any more questions, please ask. If I have 5 crore INR to dollar outward remittance in next 6 to 8 months, what would you suggest? Mr. Rajesh, I will answer your question. You have a 5 crore outward, which effectively means it's around 4.5, $5 lakh, $5.5 lakh. Okay, so I think you should certainly hedge because the way the dollar INR is moving and the way the RBI has a hands-off approach, and all of us are aware about the geopolitical developments, I would suggest you should hedge. You should not keep it open. You should hedge at every 30, 40, 45, 50 paisa dip. You should certainly look to hedge. Okay. It is not a time when the markets are going to be stable. It is a time when markets are going to be volatile. And in volatility or in volatile times, it is always better to hedge. And as we have seen, and I'm sure you would have also observed, it is always a two-way movement. So after a peak, like it touched a peak yesterday, it was stable today. So after a peak, if we see 50, 60 paisa, or let's say 0.5% or 1% lower than the peak, you should certainly look to hedge. Okay, overseas sellers are not ready to take LC. What we can do is, Mr. Shubham, let us connect. This is a slightly difficult question to answer, and it will require a lot of interactions. And I will give you solutions which can help in some way or the other, or there will be other different ways to do it. Okay, so any more questions? So all of you, as I have requested, please join our research community. The link to join on WhatsApp is shared on the chat box, and Rohit has already given his email ID and mobile number. So if you want to reach out to us for any questions on currencies, anything under the sun for foreign exchange, you can come to us. Okay, we will be there to guide you. Now there are multiple financing options available for advance payments. Okay, typically for advance payments, buyer's credit is not there, but there are multiple banking and funding options available depending upon what kind of advance payments are you doing. Okay, buyer's credit cannot be done for advance payments; it can be done for balance, but there are other funding options which my team will certainly guide you. Obviously there needs to be certain limits and there are other limitations that will be there, but my team will guide you. Okay, there are a lot of banking facilities available which can be used for advance payments. Okay, so it is 6:01 and I do not want to take more time from you. So thank you so much, ladies and gentlemen, for joining this session. I hope you found some value and some insight that I will try to teach to all of you. Multiple things that I covered. You can join the community. You can connect with Rohit. If you want to connect with me separately, you can connect with Rohit. We will fix up a schedule, and then you can certainly connect with me. You can join our WhatsApp community, and please share your feedback form as to how the overall session went. Ladies and gentlemen, and all of you have a great weekend and evening ahead. Thank you so much. Take care. God bless. Bye bye.